right? So they are used in calculating the profit of the overall company, not a specific job. So example include salaries expense of employees who are working in marketing, selling, or administrative capacity. Number two, advertising expense that are expense in the period incurred. So we purchase a billboard that will show our advertisement for a whole month. That is our advertisement expense, that is non-manufacturing cost. So how we adjust the non-manufacturing cost? We are not charging to work in progress, we're just charging to the liabilities. Simple. Salary expense to salary payable. Salaries occurred but not paid. When not paid, we create liability. Similarly, expense occurred but not paid, we call the advertising company, okay, run our ads, then we pay you later. We call this account payable. Advertising expense to accounts payable, right? And now here we go. So all these three, we call this cost of goods manufactured. When you add all this, we call this cost of goods manufactured, right? So this amount will go to the finished goods. Now we have completed our work in progress. We need lumber, we need nails, we need lubricants, we need hammer, anything we need that, we call this in overhead, direct lumbers and all those is direct material. The workers that are working for us is direct labor. So the amount will become cost of good manufactured. It means goods are ready and they are ready to transfer in finished good account. So we created a finished goods. So the hierarchy is that first raw material. The raw material will go to make the goods, finished goods through work in progress, which are unfinished goods. Some books call it work in progress and some books call it work in process. So don't worry about that, okay? Let me just change it, work in process. And when the goods are complete, then they are transferred to finished goods section, right? So when this happens, let me just clear all this mess here. So as jobs are completed, the cost of goods manufactured is transferred to finished goods from work in progress. So when you transfer, it means you are going to increase the finished goods. Finished goods is our inventory. Increase in finished goods mean increase in asset, which is debit side. And since you are decreasing the work in progress, decrease in work in progress means decrease in inventory. Decrease in inventory means decrease in asset, which is credit. Right? So recall our discussion regarding the rules for debit and credit. Asset increase, debit. Asset decrease, credit. Liability increase, credit. Liability decrease, debit. Similarly, with the owner's equity, when owner's equity increase, debit. Owner's equity decrease, credit. So we have two exceptions regarding dividend and expenses. If expenses increases, always debit. They belong to owner's equity, but we make it debit. And now when the goods are sold, so remember this is goods of manufacture, not the all amount is going to be sold, or all the goods are going to be sold, right? Some of them are going to be sold. When some of them are going to be sold, then these will go to our expenses. Special name is cost of goods manufactured, which is a part of income statement account, right? So when goods are sold, they transferred to our income statement account, which is cost of goods sold. So that cost will go to the cost of goods sold. And the balance is our inventory that will remain in our balance sheet under finished goods, right? So when you transfer the unit, when sale happen, it generate two activities or two entries. Number one, you record the sales, and then you records cost of goods sold. Number one, when finished goods are sold, it generates sales. Cash to sales or account receivable to sales. If on credit, then account receivable to sales. If on cash, then cash to sales. Okay. And then the next part, next entry would be how much units are sold. So we call it here cost of goods sold to finished goods. Right? Remember, we are decreasing our finished goods inventory. Decrease in finished goods inventory means decrease in inventory. Inventory decrease means decrease in asset. Decrease in asset means credit. And since goods are sold, all the expenses to make that goods will become your expense. And the specific name of that expense is cost of goods sold. Right? And now compute under-applied or over-applied overhead cost and prepare the journal entries to close the balance in manufacturing overhead to the appropriate accounts. So problem with the overhead application, we just talked about in the previous lecture, and we also talk about right now that if there is a disbalance, then adjustment is needed. So we are now heading towards solving that problem. So the difference between the overhead cost applied to work in progress and actual overhead cost of the period is referred to as either under applied or over applied overhead. Don't understand that? Here we go. Let me just see our work in this manufacturing overhead. Here we go. Just clear all the stuff here. So here, the difference between these two generates a discrepancy in our planning because we applied in advance, and when we compare our forecasting with the actual one, so difference must be adjusted, and the name of the difference is either under applied or over applied, right? Here we go. So what is under applied overhead? Under applied overhead exists when the amount of overhead applied to job during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the period. So you see here, wait. So under applied overhead, you can write it down, the definition as when our estimation or our applied manufacturing overhead is less than the actual one. When our estimation is less than the actual one, we call this under applied, which means we underestimated, right? So the name is called under applied overhead. So when our applied, which means when our estimation is greater than the actual one, it means the cost that we charge to the work in progress is over, right? We call this over applied overhead. Let me just repeat one more time. If the estimation is less than the actual one, or if the applied overhead is less than the actual one, then we have under applied. If our estimation or our applied overhead is greater than the actual one, then we over applied, right? So what are the treatment for this under and over? So remember, this is just a discussion here. So when we over applied, what does it mean? It means our estimation is greater. It means we need to reduce our estimation. So the sign with the over applied would be negative. So over applied will reduce the manufacturing overhead. Under applied means the amount we charge our estimation less. The estimation is less, actually is higher. So the under overhead, which actually we hired less, it means it will increase our cost. So under applied is going to be added in manufacturing overhead so that we can increase the cost, right? So let's talk about this. We have PeerCo example here, that PeerCo actual overhead for the year was 650,000 with the total of 170,000 direct labor hours worked on job. So we are given the actual amount of overhead and we are given the actual amount of direct labor hours. So how much the overhead was applied for Pierre's job during the year using the predetermining overhead rate? So recall our discussion regarding predetermining overhead rate. So if we want to compare the results with refer to the 170,000 direct labor hours, what would be our estimation based on 170,000 direct labor hours? We just multiply 4, which is the predetermining overhead rate, with the 170,000 direct labor hours. Let me share this PPT again. This is just hard right now. And here we go. So we have given the actual amount of direct labor hours and actual manufacturing overhead, and we have given 4 predetermining overhead rate. So what would be the applied overhead rate based on 170,000 hours? So 170,000 multiplied by 4. Answer would be 170,000 multiplied by 4. It is 680,000. So if we planned based on 170,000 direct labor hours, our applied or our estimated manufacturing overhead would be 680,000, but actually it was 650,000, right? So let me just clear and see the answer here. See, 680,000. Now, let me know. This is over or under? It is over how? Because your applied or your estimate